Today, we're doing a complete breakdown of AASB 15. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying AASB, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine two tech firms recognizing revenue from the same contract differently, one up front, another over time. Pre-2018, such inconsistencies were common, muddling financial statements. AASB 15 brought clarity by aligning revenue recognition principles across industries. After this, you'll grasp how AASB 15 ensures uniformity, enhancing comparability and transparency in financial reporting. AASB 15 was born out of the chaos of diverse revenue recognition practices. Imagine industries with unique rules, causing misleading figures. This standard replaces multiple outdated guidelines, ensuring a single coherent approach. With AASB 15, financial statements reflect true performance, removing ambiguity and enhancing comparability across sectors. AASB 15 is mandatory for entities under AASB from January 2018. It revolutionizes revenue recognition by emphasizing the transfer of control in transactions. Every contract with a customer falls under its scope, mandating a structured 5-step model. This single requirement harmonizes how revenue gets reported, ensuring clearer financial statements. AASB 15's 5-step revenue model is pivotal for understanding revenue recognition. Start with identifying the contract, then pinpoint performance obligations within it. Set and allocate the transaction price. Finally, recognize revenue once obligations are fulfilled. This model clarifies revenue reporting, and mastering it is crucial for acing finance interviews where precision matters. Understanding the scope of AASB 15 is crucial. Many candidates confuse its exclusions, such as leases, which fall under AASB 16. Recognizing these boundaries ensures compliance and avoids common traps in interviews and practical scenarios. AASB 15 primarily applies to contracts with customers for goods or services. Imagine a tech company selling software licenses. These are clearly within scope. Contracts must create enforceable rights and obligations to qualify. Service agreements, product sales, and software licenses are key examples where AASB 15 takes charge. AASB 15 excludes several key areas like leases, governed by AASB 16, and insurance contracts, under AASB 17. Financial instruments are another exclusion, covered instead by AASB 9. These distinctions are crucial, as interviewers often test your knowledge of these boundaries. Misunderstanding these can lead to significant compliance errors. A contract under AASB 15 is more than just a piece of paper. It's an enforceable promise between parties. Imagine a 1-year IT service agreement. It creates enforceable rights and obligations. Even verbal agreements count if enforceable. This definition ensures precise recognition of revenue and obligations in financial statements. Performance obligations in AASB 15 are promises to transfer distinct goods or services. Think of a software package bundled with annual support, 2 separate obligations. Each must be evaluated independently for revenue recognition. Distinct items mean the customer can benefit on their own, ensuring clarity in reporting and compliance. Scope edge cases challenge even seasoned professionals. Imagine a contract with goods and a lease. AASB 16 governs the lease part. A customer loyalty program often introduces separate performance obligations. Subscription upgrades need careful evaluation under AASB 15. Construction contracts with milestones demand precise revenue recognition strategies. These scenarios test your practical understanding and readiness. Imagine a company struggling to recognize revenue from complex contracts. AASB 15's 5-step model brings clarity. It transforms how companies like SaaS providers account for multi-service deals, ensuring revenue is booked accurately and predictably. Mastering this model is crucial for any business seeking financial clarity and compliance. The 5-step revenue model simplifies revenue recognition in complex contracts. We'll explore Meridian Corporation's $10 million SaaS contract. It includes an $8 million software license and $2 million for implementation services. This model ensures revenue is recorded consistently, reflecting true business performance. By following each step, you'll see how to handle multi-element arrangements with precision. Meridian Corporation's $10 million SaaS deal with Acme Incorporated starts with confirming a valid contract. This step checks enforceable rights and obligations, ensuring both parties agree on terms. By establishing a binding agreement, revenue recognition proceeds on solid ground. Many misstep by assuming informal agreements suffice when they lack enforceability. Remember, AASB demands commercial substance and mutual approval. With this contract confirmed, we move to identify performance obligations. With the contract intact, Meridian Corporation now identifies distinct performance obligations. Step 2 dissects if the $8 million software and $2 million implementation services stand alone. Missteps here often include bundling distinct services, skewing revenue allocation. AASB emphasizes that obligations must be distinct and separately identifiable. By segregating these obligations, we pave the way for accurate price determination in the next step. Now we focus on pinpointing the transaction price for Meridian Corporation's $10 million contract. This includes assessing any variable considerations like discounts or penalties. Misjudging these factors leads to inaccurate revenue figures. AASB insists on evaluating all variables, ensuring a precise price is set. With this detailed evaluation, we're ready to allocate this price to the distinct obligations identified earlier. Step 4 is about spreading Meridian Corporation's $10 million transaction price across the software and service obligations identified in Step 2. This allocation should reflect their standalone selling prices, avoiding arbitrary methods that distort revenue recognition. AASB insists on allocation based on standalone prices to maintain accuracy. With a clear allocation, we ensure revenue is recognized properly when each obligation is satisfied. Finally, Meridian Corporation recognizes revenue as each performance obligation is satisfied. This step ensures revenue aligns with the completion of software delivery and implementation services, as allocated in Step 4. Premature recognition is a common mistake, leading to financial misstatements. AASB demands revenue be recognized only when obligations are met. With revenue correctly recognized, Meridian's financial statements reflect true performance, closing the loop on this $10 million contract. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. AASB 15 demands precise recognition of revenue from contracts with customers, ensuring both measurement methods and disclosures reflect the true economic reality. Let's explore the choices and mandatory disclosures that keep financial statements both compliant and transparent. Revenue recognition under AASB 15 hinges on when control transfers to the buyer, moving away from delivery-based triggers. Consider how a software company might recognize revenue only when the user accesses the service, rather than at sale. This approach ensures revenue reflects the actual economic activity. Allocating transaction price by performance obligations clarifies earnings visibility. Subsequent measurement involves periodic reassessment of estimates like variable consideration, ensuring the transaction price remains accurate amidst changing factors. If a contract's scope expands, the financials must reflect this, perhaps raising revenue by $100,000. Adjustments maintain revenue alignment with current realities, without revisiting initial recognition principles. This vigilance ensures financial statements stay relevant and factual. AASB 15 mandates clear presentation of revenue as a separate income statement line item, ensuring financial statements communicate effectively. Contract assets and liabilities highlight deferred revenue or prepayments, providing insight into cash flow timing. Imagine a tech firm recognizing $500,000 in deferred revenue due to annual subscriptions. Detailed notes enhance transparency, revealing performance commitments and pricing clarity. AASB 15's disclosure demands transparency, starting with disaggregated revenue, essential for spotting trends. Significant judgments reveal subjective areas like variable consideration assumptions, aiding investor understanding. Contract balances, such as a $200,000 receivable, illuminate cash flow timing. Highlighting performance obligations showcases future revenue potential, ensuring stakeholders grasp a company's financial trajectory. Imagine a CFO at a retail chain managing a $10 million supply contract with a delayed delivery clause. Properly aligning revenue recognition with contract specifics avoids overstating earnings by $2 million. Accurate forecasts require evaluating variable elements like discounts. Regular updates to reflect contract changes are vital, while auditor collaboration ensures regulatory adherence and financial transparency. Meridian Corporation, a global manufacturing company, enters a contract to deliver custom machinery worth $2 million. This detailed journey shows each accounting event under AASB 15, revealing how revenue recognition impacts their financials. Initially, Meridian Corporation recognizes a contract asset and corresponding revenue for the full contract value. This aligns with AASB 15's requirement to recognize revenue when control is transferred, even if cash isn't yet received. The entry impacts the balance sheet, reflecting the company's right to consideration. Meeting the first milestone means transferring control of the machinery to the customer. Under AASB 15, this justifies recording an accounts receivable, reducing the contract asset accordingly. This entry ensures the balance sheet reflects the $500,000 now collectible. The cash receipt confirms the settlement of the accounts receivable, reflecting an increase in Meridian Corporation's cash balance. AASB 15 specifies that receiving payment finalizes the revenue recognition for the delivered portion, maintaining a clear financial position. The second delivery signifies further transfer of control, requiring recognition of additional $1 million in accounts, recovery.tsc, while decreasing the contract asset. AASB 15 mandates this systematic approach to reflect performance obligations fulfilled over time. Recording the cash inflow for the second delivery clears the accounts receivable, enhancing liquidity as per AASB 15. This demonstrates an ongoing conversion of sales into cash, reinforcing financial health and strengthening the balance sheet. The final delivery ensures that all remaining obligations under the contract are met, updating accounts receivable accordingly. AASB 15 stipulates that revenue is fully recognized when performance obligations are completed, ensuring transparency in Meridian Corporation's accounting records. The final payment receipt closes off the accounts receivable, marking the contract's completion. With the $2 million fully collected, Meridian's books reflect the contract's full cycle. AASB 15's framework ensures that financial statements accurately depict Meridian's operational success. Every Big Four and investment bank interview on AASB 15 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. A performance obligation is a promise to transfer a distinct good or service. AASB 15 requires entities to identify each performance obligation in a contract. For example, a software license and installation service are distinct obligations. A common mistake is not separating these. Remember, all obligations must be clearly identified to ensure accurate revenue recognition. AASB 15 provides a framework for consistent revenue recognition, replacing multiple previous standards. It was introduced to align with global practices, eliminating revenue reporting inconsistencies. The 5-step model clarifies when revenue is recognized, enhancing comparability. Avoid assuming old rules apply. AASB 15 requires a new approach entirely. Consistency and transparency are its core goals. AASB 15 recognizes revenue over time if the customer receives and consumes benefits simultaneously. For example, subscription services meet this criteria. Point in time applies when control transfers at a specific moment, like product delivery. Trap: misunderstanding these criteria can lead to incorrect revenue timing. Always assess contract terms carefully to determine timing. Revenue should be allocated to each performance obligation based on their standalone selling prices. AASB 15 mandates this allocation to reflect true economic benefits. For instance, a package of goods and services must be priced separately. Avoid lump sum allocations; they can distort financial results. Properly identifying and pricing obligations ensures accurate reporting. AASB 15 and Indian Accounting Standard 115 are largely aligned, but minor differences exist in implementation guidance and disclosures. AASB 15 might have more detailed guidance in certain areas, while Indian accounting standard focuses on principles. Misinterpreting these nuances can affect compliance. Always compare specific contract details under both standards to ensure accuracy. AASB 15 changes revenue recognition timing, affecting income statements and balance sheets. Revenue may be recognized earlier or later, altering profit figures. For example, long-term contracts may now recognize revenue over time. Misjudging impact can lead to misstatement risks. Assess each contract's implications carefully for accurate financial reporting. Calculate transaction price by estimating variable consideration, adjusting for discounts, and factoring in non-cash components. For instance, a loyalty program may affect expected consideration. Avoid ignoring variable components, they can skew results. Always use the expected value or most likely amount approach to ensure precise calculations. A CFO must disclose disaggregated revenue, contract balances, and performance obligations. AASB 15 requires detailed notes on revenue timing and uncertainties. For example, disclosing remaining performance obligations helps stakeholders assess future revenues. Overlooking these can lead to compliance issues. Thorough disclosure ensures transparency and investor confidence. AASB 15 excludes leases, insurance contracts, and financial instruments. Candidates often mistake these due to overlapping coverage in other standards. Misclassifying contracts can lead to incorrect revenue reporting. Always reference specific guidance for exclusions to ensure compliance and accurate financial statements. Understanding boundaries is crucial for proper application. Allocate transaction price based on relative standalone selling prices. A common trap is treating bundled discounts incorrectly, leading to misallocation. For instance, offering a discount on a bundled package requires careful assessment of each item's standalone price. Avoiding this trap ensures accurate revenue recognition and reflects true economic activity. AASB 15's objective is to ensure revenue recognition reflects the transfer of goods and services. It applies broadly, excluding leases, insurance, and financial instruments. Key terms include contract, which creates enforceable rights, and performance obligation, a promise to deliver distinct goods or services. The transaction price is what you expect to receive, and revenue is earned income from business activities. A customer is simply the party acquiring goods or services. The 5-step revenue model guides you through revenue recognition. Start by identifying the contract and its performance obligations. Determine the transaction price and allocate it accordingly. Revenue is recognized when each obligation is satisfied. Measurement hinges on the transaction price assigned to obligations. For variable consideration, only include amounts likely to avoid significant reversal. This model ensures accurate and timely revenue recognition. Mastering AASB 15 for interviews means understanding potential pitfalls, like misidentifying performance obligations. While it aligns with International Financial Reporting Standards 15, watch for Australian-specific guidance. Disclosures are crucial. They include both qualitative and quantitative contract details. Highlight any significant judgments made. When contracts change, treat modifications as separate if they add distinct goods. Allocate prices using standalone selling prices. Timing is key, with revenue recognized either over time or at a single point. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.